So you're getting close to retirement and you have questions like, how much money do I need to have saved to retire on my own terms and secure my retirement lifestyle? How much money can I spend off of my portfolio on an annual basis? I've been doing financial planning for wealthy families for over 25 years. And along the way, I've developed a simple, common sense financial planning approach that I always use in conjunction with a sophisticated software-based financial plan. In today's video, I'm going to show you how you can quickly build your own common sense retirement plan. I call this approach common sense because it is so incredibly simple, yet extremely effective. Most people today are focused on using software for financial planning, and I am a huge believer in software. I have some of the best. But software can get you in a lot of trouble real fast. I have a video dedicated to mistakes that you can make when using software to develop a financial plan. I would encourage you to watch it. There are many ways that you can get into trouble with software. To develop your own common sense retirement plan, all you need to get started is an accurate retirement budget and the amount of money that you expect to receive from Social Security, any pensions, or other guaranteed income sources. That's it. Once you have those two variables, you can begin to develop your own common sense retirement plan. In this presentation, I'm going to review an example common sense retirement plan so that you can see the structure that you will need, the framework to develop your own retirement plan. You're going to be amazed at how simple it truly is. After we review the example plan, we're then going to look at 3 different illustrations so that we can test the validity of this approach. Here is a common sense financial plan. You can do this on a half a sheet of paper at your kitchen table. It's super easy and very effective. You want to start with your retirement income goal. So you need to develop what your expected budget is, an accurate budget for your retirement. Then add up your Social Security. In this example, we have $80,000. This would be for probably a couple. They're looking for a $150,000 retirement income goal. Now we know how much money you're going to need, $70,000 off of your portfolio. The difference between your retirement income goal and your guaranteed income sources is what you need to spend every year off of your investments. If you want a conservative retirement plan, you would divide the $70,000 by 3%, and that tells us that you need $2.3 million in your portfolio to secure your retirement lifestyle. If you want a moderate risk retirement plan, then just divide your portfolio distribution by 4%, and you need $1.75 million to retire. If you want to be a little bit more aggressive and cut it close, then you would use 5%. Divide the $70,000 portfolio distribution by 5%, and you would retire on $1.4 million. As you can see, it's really easy to develop this type of plan, and it doesn't take a lot of time. This is a 5-minute exercise. As long as you have an accurate budget, everything flows from there. It's hard to screw this up. Unlike software, where you can make so many mistakes, it's difficult to mess this up. As long as you have a good budget and you accurately tally up your guaranteed income sources, which would be Social Security, and then a pension if you have one, it's hard to make a mistake here. Now let's backtest these numbers with a moderate allocation mutual fund over the last 25 years to see what the results are. What is the validity of this approach? Our example plan calls for a $70,000 portfolio distribution in the first year. If you plan to be in retirement for 25 to 30 years and you expect inflation to be around 3%, that means that the portfolio distribution after 25 years is going to basically double. That's what's happening here. What I'm doing is I'm inflating $70,000 by 3% each year for inflation, and after 25 years, we're at $146,000 portfolio distribution. What we're going to do here is we're going to look at 3 different illustrations using this distribution sequence over the last 25 years, starting on January 1 of 2000, taking the distribution off of a moderate allocation mutual fund, an index fund. We're going to look at 3 different scenarios. Scenario 1 is going to be 3% spending with 3% inflation. Scenario 2 is going to be 4% spending, i.e. moderate risk plan, with 3% inflation. And scenario 3 is going to be 5% spending, i.e. an aggressive plan with 3% inflation. Let's take a look at the results. Here's the back test for our conservative retirement plan, common sense plan over the last 25 years. Recall that we needed $2.33 million to support a $70,000 distribution. So we're taking 3% off the portfolio and then we're growing it by 3% for inflation every year. We're using the Vanguard Balanced Index Fund Admiral Share Class, starting on January 1 of the year 2000 with a $2.33 million investment and then taking that distribution sequence that I showed you off of the portfolio. The investment today would be worth $4.23 million. This is why I call this approach a conservative approach, using 3% to calculate the amount of money that you need to retire. You have been able to increase your distribution over the last 25 years, but you've also been able to grow your principal. You had bad timing in this example by starting in the year 2000. You got hit with a recession right away. And you had sequence of returns risk. 2000, 2001, 2002, 3 negative years in a row, and yet you survived all of that by using a 3% spending rate, distribution rate off of your portfolio. Hence, conservative plan. Remember, this is just an illustration. If you had used a financial advisor or a stockbroker and paid them fees or commissions, your returns would have been less than what you see here by the amount of commissions or fees that you paid. Also, I want to point out that this balanced index fund is a 60-40 equity to fixed asset allocation fund, which many people believe to be appropriate for retirement. On a 1 to 10 risk scale, this would be a 6 risk score. Here is the moderate risk common sense plan backtest. In this example, we're starting with $1.75 million. We're spending the same amount of money in absolute terms, $70,000 in the first year, grown by 3% for inflation. But in relative terms, we're now spending 4% off the portfolio. So we start retirement with less money. This is where we end up, $1.29 million. It makes a big difference when you go from 3% to 4% distribution. It increases the chance that you could run out of money during your retirement. This 4% distribution retirement plan is going to work for most people. The odds that you would run out of money in retirement are fairly low, provided that you have a diversified, balanced portfolio, that you don't time the market, i.e. you stay invested, and you review your financial plan at least annually. If you do those things, the likelihood that you're going to run out of money in retirement is fairly low. When using the 4% retirement distribution plan, it is definitely possible that your nest egg may decrease in value throughout your retirement. You might not run out of money, but you might die with less money than you started retirement with. For some people, that is just not going to be tolerable. Not everybody can accept that. So if you like the added security of seeing your retirement nest egg grow during retirement, then you would want to select the conservative plan, the 3% plan. But if you're okay watching your portfolio diminish somewhat throughout your retirement, then the 4% plan is going to be okay for you. Whether your portfolio grows or decreases throughout retirement when using the 4% retirement plan is going to be based upon your timing. Were you lucky or unlucky? In this example, the person was unlucky. They retired right before a recession, and the 4% spending rate grown for inflation was just a little too much on the portfolio. So 25 years later, they have less than what they started retirement with. If you want to grow your portfolio value in retirement and you want really high odds of growing the portfolio value in retirement, then you use the 3% plan. If you're indifferent, then you can use the 4% plan. Or if you're willing to see your portfolio value decline in retirement, you can use the 4% plan. And I think you're still going to be relatively safe with the 4% plan. Here's the back test on the 5% retirement plan. Starting the year 2000 with $1.4 million, after 23 years, you're out of money. The impact of bad timing and a high distribution rate off of the portfolio results in this person running out of money, likely before their retirement is over. That is a situation that all retirees fear. And for that reason, I call a 5% distribution retirement plan an aggressive retirement plan. It is possible with this 5% retirement plan that you could grow the value of your portfolio throughout your retirement and obtain very different results from what we see here. That's all going to depend upon your timing. Were you lucky or unlucky? Did you retire at the bottom of a stock market crash, or did you retire at the beginning of a recession? If you retire at the right time, then the 5% retirement spending plan may not be such a big deal. You might do really well. But if you retire at the wrong time, then it could sink your battleship, so to speak. You need to take note of the business cycle. Where are we at in the business cycle when you retire? You don't have a lot of control over timing when you retire. When you're 65 or 67 and it's your time, you don't have the luxury of waiting another 5 or 10 years. When it's your time to go, you go. And you have to deal with the cards that you've been dealt at that time. So if by looking at the business cycle when you're retiring, it looks like we're very close to a recession or in the early stages of a recession, then maybe you start your retirement with a 4% or a 3% plan. But if we've just been through a recession and the stock market is way down in value, then you might be able to get by on a more aggressive plan, hoping for a rebound. You could use a 5% plan, possibly. Again, everybody's risk tolerance is different, and you need to look in the mirror and see how you really feel. But definitely consider where are we at in the business cycle when deciding upon a risky, moderate, or conservative retirement plan. If you have questions about your investments, please give my office a call. We would be happy to give you a second opinion on your portfolio. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.